All right, we're back with the latest edition of the quarterly markets webinar here with Zenith Wealth Partners.
I'm Andrew Tudor here with my co-host and Chief Investment Officer Jason Ray. I'll kick it over to you.
Yeah, it's great to be here again. We've been doing this. Andrew, it's a pleasure. Why don't you go ahead and set the stage for everyone?
Yeah. So for today, if you've joined us before, we're going to take our look at Q2 takeaways, how the markets performed, talk about our key themes for the year and how they've been developing over the last three quarters now. And then we're going to look ahead and see what are we expecting when it comes to equities, bonds, overall inflation, tariffs, all the things that might be on your mind, and then give a section for Q&A to make sure we can make sure all your questions are answered before you walk away today. All right. And so let's do this recap. So it has been, and as you'll see, it has been a good quarter and year for equities. US equities at 8.12% over the last 3 months, taking it up to 14.83% for year to date. For context, a 12% year is what happens on average. So for us to be going into the last quarter with almost a 15% rate of return is historically outstanding. We've also seen a return to prominence for international equities at 26.02% for the year, and bonds coming in at 6% as well. So we've seen global equities post strong gains. We've seen the US really rebound in the last couple of quarters as well. And then as rate cuts are happening and projected to happen, it's creating an interesting dynamic with our bond portfolio, specifically our mid and long term bond portfolios. And so we still see some inflation pressures, and we'll hear that as we talk through more later, kind of what that does for the portfolio. But very interesting and overall positive quarter. And let's get to what that means for us in our outlook. We always like to frame this conversation with our uh, asset class returns. So we develop diversified portfolios, and when we think diversity, we're thinking global diversification. We're thinking different uh, geographies, different sizes. And so what you'll see is, an asset allocated portfolio holds a lot of the winners and losers of any quarter or any year. But overall, we have that steadiness and conviction as we create portfolios for clients. So, we can tweak how much of a certain asset class is inside the portfolio to give more, higher risk and higher projected return. But it's always important to keep it globally diversified and many asset classes in the portfolio so we can achieve the financial goals of either an organization or your family, to make sure that we can, achieve retirement or achieve whatever those financial goals are.
And I want you to picture a garden with a lot of different type of plants. Some bloom in the rain, some bloom in the drought, some bloom in shade. A diversified portfolio is one. It is that garden where one patch wilts, another one thrives. This is asset allocation, right? It's resilience through variety. And when you think about markets, it's really like seasons. You can't predict the first snow or the last bloom, but staying through all four is what makes kind of the weather beautiful. And investors who keep walking through the sun and the storm instead of waiting for the perfect day end up covering more ground, right? There's no upside in time in the market. Even though markets have screamed and we've seen a great year, investing at the top of the market, just like investing at the bottom, proves to provide similar results for investors over a 1, 3, 5 year journey. And that's what this chart is really showing. So we want to make sure, as we see markets and valuations high, let's not be weary about putting new money to work and doing so in a diversified fashion. We've got some key themes that we watch. This is kind of our system, right? Monetary policy shift. It's starting to change directions, right? The breeze is slowing. And we've seen over the last few years a number of rate hikes, but this year we've seen rate cut. We're starting to see global growth moderate, right? We're seeing uneven growth across different countries. Some regions are seeing, strong GDP growth, and others are remaining a little bit overcast. I think the geopolitical tensions are pretty clear, right? There's really unpredictable crosswinds. I think, like, as we look at our leaders interacting across the globe and through trade or through other things that we'll cover here. This could reroute, a plan for an investor quickly. And I think it's definitely a thing we want to pay attention to. And then lastly, the values alignment, right? I think you can choose the short route, where you're kind of trying to extract as much profits and returns as you can. But as we've seen in the economy and as the world has changed and demographics of the worlds are changing, taking the scenic route and really incorporating your values into your portfolio is the long game that will benefit investors long term and really drive that long term value for portfolios. I mentioned we've seen some rate cuts this year. I think we can't have an investment committee meeting without, talking about rates. I think the expectation for interest rates is moving down as time goes on. This impacts everything kind of related to borrowing in the economy, mortgage rates, car rates. As rates were, rising from 2021, as you can see on the chart, up through 2023. That is an effort to slow down the economy and slow down inflation. We've seen inflation remain sticky, but we've seen the labor and employment market actually start to weaken, which I think is a key reason that the Federal Reserve is lowering interest rates. Most investors and market participants expect a downward trend ahead, and that's what we're preparing our clients and our portfolios for as well. This is related to kind of global trade and tariff rates. Think about these as like tariffs are like toll roads on the highway, right? When they multiply, I don't know, the Pennsylvania Turnpike, I drive my family from Philly to Detroit often, and it used to be $30. Now it's $120 to go on the Turnpike, which is absurd. But this is what tariffs are, right? When they multiply, trade slows down. Prices for goods rise, like congestion. The US is paying more at all of these traffic checkpoints, and so are other countries. And it's really reshaping the flow of goods and the cost of goods on that journey. You can see on this chart, I mean, tariff rates over the course of history, and when you look even further out, have been steadily coming down. Tariffs are not great for the global economy or global trade. And you can see here in, April 2025, what tariff rates are peaking at are the most in the last 25 years. And with recent announcements, I don't think these tariffs are things that are going to slow down. This has impacted trade, but it's also impacted, fixed income and equity markets. And I'll kick it to Andrew to talk a little bit more about that.
Yeah, thank you. And so, those toll roads, I love that thought process, right? Those toll roads are what folks are paying to import into the United States as our businesses, work and grow and thrive. And those aren't always the case for different trades between other countries. And so we'll see that affect the global fixed income and the global equity space. Um, as we talked about before, this has been a good year for international and global markets outside the United States as well. And on the bond side, with non-US bonds at 8% versus the 5% in the United States. As we think about changes in interest rates and Fed rate policies, there are also, other national banks in the process of cutting their rates and really trying to come down from the sticky inflation that came from the pandemic as well. So each country is playing their own tightrope game of interest rates versus inflation. And some of those countries are actually cutting rates a little faster. And so we're seeing that play out in this non-US bond space. But it's important to see as we look at the chart on the right side. The United States used to dominate the global bond market for a lot of the last 25 years, it being at least 50%, sometimes above, 75% in the early 90s of the overall bond market. And now we see emerging markets with really developing bond markets in different parts of Asia and South America that are really pushing pressure on US bonds. And so we'll see this continued expansion and options for bond buyers and purchasers to be able to shop around and find, other global strong uh, bonds to buy in the international space. And then when we think about equities, jumping into global equities, the United States continues to be a large portion of the global equity markets, right? If we look at the MSCI, 65%, which means if we bought a global equity portfolio, 65% of that portfolio would be domiciled in the United States. That's a lot of growth. That's a lot of market share. And we know that, with the AI boom, with Silicon Valley redoubling down and getting investments globally for building out its AI infrastructure, that this is expected to continue. What we are seeing in a lot of our international markets is that although we're investing heavily in technology and AI in the global market and in a lot of parts of Europe and developing spaces, it's not necessarily technology. It's developing in, industrials, healthcare, finance, some of the more boring side of the market. And that balance gives us the ability to invest in technology in the States and then invest in some of those core, tried and true older companies in these global markets to give us a diversified portfolio across a lot of industries as well as geography. And so when we think about the tie between the US dollar and global equities, it's laid out pretty well in this chart that as we see falling dollar prices relative to other currencies and a weakening dollar, a lot of times, directly on the heels of that, we see some global outperformance or some international outperformance over the states. And so I'll hand it over to Jason to talk through this one a little bit more.
Yeah, I mean, for US investors, the US dollar is really the tide beneath your ship, right? When it swells and gets more valuable versus foreign currencies, US assets, both credit and equities, ride high and international credit and equities dip. But when the US dollar pulls back and gets less valuable versus its foreign currency peers, those foreign assets become accessible again, right? And what we've seen recently is that foreign currencies are gaining on the U.S. dollar, and opportunities in international markets are coming to light that were once underwater. And you can see for a U.S. investor that owns international holdings from 1998 to 2007, it was an unbelievable run for a U.S. investor investing in international markets. And it played out over a long period of time, right? But since 2000, really since 2008, we've seen the US dollar remain extremely strong versus international peers. We've seen some periods of strength, like in 2017, for international currencies against the dollar. But what we've seen really since the end of 2022 is that as we've seen policy changes in the United States, as we've seen debt pressures here in the United States with our own kind of fiscal budgeting process and spending, and our own consumer spending versus that spending in other countries, we've seen other currencies really gain ground in the US dollar. And as we look ahead, I expect to see some of the same things because of the tariffs that we see in our economy, because of the debt that we have in our economy. And I think it's really important for US investors to own international stocks. For a long time, majority of our careers, a lot of folks have taken the strategy of, maintaining a savings account and then investing in SPY or kind of the US index, and everything was gravy and it was all good. If you're doing that today, you're missing out on a lot of potential growth. And, I would argue that that's really not a prudent approach at all. And speaking of ships, I think imagine kind of steering your ship not just by its compass and your required return, but by its conscience, right? I think a lot of investors in the market today, we see it in our own client base, both with families and the institutions that we work with. Investors are realizing that returns are not only about wealth, right? It's about impact. Portfolios are now passports with ethical stamps, and they're really marking destinations of responsibility, equity, sustainability. People believe that socially responsible investing is important. People are seeing the weather changes, and we were joking earlier that, like, is it even going to snow in Michigan this year because it was 90 degrees last week, right? What is going on with the environment? How are younger investors indicating that sustainable investing should be reflected in their portfolio? And how are we as investment advisors really setting the expectation that you can realize the returns and your plans that you need to realize by aligning your portfolio with your values, and you'll likely outperform if you didn't do that. So I'll kick it to Andrew to talk a little bit more about some of the values alignment by sector.
Yeah. And that's a perfect segue. Thinking about how conscious shows up in your portfolio, how values show up in your portfolio. A lot of the organizations that we're working with and families that we're working with have expressed that racial justice and equity, even with some of the backlash, is still a very important piece of their investment portfolio. And they like to see how we can make sure that we get the returns that the family or the organization needs, but also give them that alignment. And what we're seeing in it is getting tougher and tougher in the racial justice space. So these are scores out of 100. And you'll see that, from utilities to energy, the highest score is 11 out of 100, which means that if we're creating a domestic portfolio, a US portfolio, trying to keep, you know, uh, DEI initiatives or any corporate responsibility initiatives intact, it's getting tougher and tougher that a lot of the companies either aren't reporting or aren't passing the reports. And this is all pulled from one of our partners that we use, as you saw, in their data scorecard on racial justice. So if you'd like to look at those, you can pull up any company or any fund and see the scoring around racial justice. But not only that, you can do it along the lines of deforestation or women's rights or LGBTQ rights as well. And that's one of the database that we use as we want to make sure that portfolios are aligned with the values and achieving the investment returns. But that transparency and passing funds is really important as well. Um, as we move on to the next slide, we've seen something that we want to talk about a little bit more is as the BDS movement grows, we're seeing that there's a lot of conversation around what companies are currently invested in or supporting Israel. There's a global movement, and it's really taking shape in certain parts of Europe around boycott, divestment, and sanction. So this movement isn't new. It started over 20 years ago. There's a 2005 initiative, I believe. And so we just hit 20 years of really pressures, but it is growing and growing, as you can imagine, with international tensions. It really pulls from the same playbook as anti-apartheid South Africa in the 1990s, and that playbook of putting economic pressure on companies and countries that are tied economically. And so we're seeing not only questions and calls for how we can integrate, but also pressure on some of these companies as well. And it's something that we're watching as we continue to, do shareholder engagement and have conversations on creating portfolios that align with values. What does it look like, and what companies are supporting, certain conflict areas right now as well.
Well said. So looking ahead, make sure you subscribe to our investment management newsletter. We'd love your feedback on this presentation. Be sure to connect with Andrew on LinkedIn and set up a review call with your advisor. But we do want to open it up to questions. I know I saw a couple pings come through. So if you want to throw them in the chat or come off mute, feel free to kind of do whatever you please. We'd love to entertain a couple.
We've got a question here. Which industries are most exposed to elevated tariff levels?
Yeah. I think so. Just to take a stab at this one, we've seen such a huge spike in capital investment in sectors that have intangible assets. So thinking about technology and artificial intelligence in particular, is one where, tariffs may not have an impact at all. The tariff rates that we've seen have been on goods, not services. So the economy is driven by both the sale of goods and services and the trade of goods and services. So service-based industries should be relatively immune to tariffs. But industries that are moving supplies and moving goods like automotive, industrial metals, manufacturing, semiconductors, agriculture, medical devices are all industries that are going to have to contend with new tariff rates to, move their goods internationally. A lot of companies have thought about anti-globalization and really onshoring manufacturing so that, they can produce their goods in the country to where they sell them. But we still see a good amount of international supply chains in the market today, and the tariffs have certainly slowed that. I think that this tariff piece and just like the rise of intangible assets is definitely correlated, right? We see so much capex in technology and AI, and the tariffs are only fueling more of that. So if you're not exposed to the top end of the index there, as we think about portfolio construction, we have really thought about how do we get our clients exposure not only to US markets and global markets, but the companies that are investing the most capex in intangible assets are driving index returns.
Agree. Agree. Next question is, can we talk about views on recession, if we'll enter one? Yeah, overall thoughts on recession and whether we are headed towards one. I can start with this answer is so going into this year, there was increased expectations of a recession. I think there was a point in which overall economists had moved to an average of 60% expectation of a 2025 recession. Uh, and what we ended up with was an outstanding year from an investment management standpoint, globally and domestically. And so it's a really hard call. There are some things that are pushing us towards thinking about playing defense in our portfolios for a potential recession. The stickiness of inflation, the expensive relative price of other companies in the United States versus their global counterparts. And then you have the geopolitical tensions and the internal tensions. And so there are a lot of reasons for pause, but too early to expect a recession in this next year. I think when we create a portfolio and we think about kind of that uh, resilience through variety, I really like that. Jason said that earlier. That's really going into our asset allocation mix is expecting there to be volatility and making sure that the portfolios are built for a potential recession. But I think it's a little too early to call that we'll have one because for the last 2 years or so, a lot of economists have been calling it, back and forth wrong in some ways, and we would have missed out on a lot of market returns had we divested in the beginning of this year, expecting a recession in 2025.
Great point.
Additional thoughts? Yeah.
I mean, just to define the recession as like 2 quarters of negative real GDP growth. So you really don't know you're in one until you get the reporting kind of a quarter later. Um, it's tough to tell if we're in one or not until we get those results. Great question. We got another one, 2% the right inflation target. And this one's specific to an endowment, but I want to take this across the board. I mean, any investor with a financial plan or an investment policy that's trying to achieve goals in the future, inflation is probably the most important variable you've got to consider. These are real world costs that people face in spending power. When we're creating financial plans here at Zenith, the inflation assumptions in that financial plan are critical to defining plan success, right? When we're setting an investment policy for an institution that wants to exist in perpetuity or spend down over a certain time horizon, that inflation expectation is critical. 2% has been the Federal Reserve's, target inflation rate for the last few decades. With that 2% target is driven by a number of things, primarily though globalization, right? So the opening up of borders for supply chain and global trade. What are we seeing now? Closing down borders, putting tariffs in place, anti-globalization, right? So would that mean that maybe inflation will get higher because prices will increase because it's harder to move goods throughout the economy? Who's to know what's going to happen with services? I don't know how they would tariff services, but I know that's been talked about. So as things become harder to flow, that means prices will go up, right? So I don't know if 2% is the right inflation target. I think what we've been modeling in for is 2.5 to 3%. Inflation's been sticky up above 2.5% for the last few quarters. And I think that's why we haven't seen the Fed lower rates as fast as people and market participants would really want. Anything on this one? What do you think, Andrew?
No, I mean we've been running. You're right, 2.5 to 3%. We haven't put a 2% inflation rate in our modeling for the last 3 quarters. Um, And, I think it's also important that not only are we trying to guess right, but we're trying to plan for what could be. So in all of our spending on the personal side, I know, retirement modeling, long term, we're doing a Monte Carlo, which basically says, what if it's 3%? What if it's 3.5? How does this affect our plan? Do we still achieve success? So we can model at 2.5, but we also plan for the fact that it could be a lot higher. And we do that in all of our planning for all of our spending scenarios for endowments as well. All right, we got another question here. Do you think government shutdown might have any short-term or long-term impacts on investment?
It should. I mean, I think we're still in a government shutdown. If we just crossed the 1 week mark, um, I think we are seeing policymakers kind of stand their ground on certain items related to healthcare in particular. We've seen government shutdowns before. This does slow down kind of the pace of government spending, which is a big driver of economic output. We also see government employees be a big part of kind of unemployment and employment numbers. So, we've seen a disproportionate number of women of color kind of reduced from the federal employee workforce over the last few quarters. The people that have been furloughed as well during the shutdown are impacted from a compensation standpoint. It does impact employment numbers. So I would absolutely think this will have an impact both on equity and credit markets. The way that companies finance themselves, the ways that organizations access government funding to run their operations, provide critical services to people. The effects of this could be more social than economic, right? You start, delaying people's like SNAP ed and food access, housing access through government funding that happens. We could see social unrest as well. So it's definitely a big consideration and one that, I don't think is really talked about enough. Great question. I see that
Yeah.
came from Helen, our fantastic intern from the University of Michigan, who helped us build these slides. So shout out to you, Helen. Thanks for asking.
I think that's the last one we have. Thank you, everybody, for joining us. Wonderful engagement, wonderful questions. And it amazing job, Jason. Give you a round of applause. Wonderful, wonderful presentation as well. So love doing these. Any questions, reach out to us. You've got the email address. And if not, we'll see you next quarter.
Thank you all. Thanks, Andrew. Another great one. See you all soon.